Good afternoon. I'm Mark Gierach, Portfolio Manager here at Styles Financial, and thank you for joining me in this week's Financial Flash Report. Today, I'd like to walk you through the Federal Reserve's latest policy decision, why it matters for the economy, and how we see it affecting portfolios. At their most recent meeting, the Federal Reserve chose to leave the target range for the federal funds rate unchanged at 4.25 to 4.50%. On the surface, that decision was widely expected. The markets had already priced in a pause, and there was no strong indication going into the meeting that a change was imminent. But beneath the surface, something unusual happened, something we haven't seen in more than 30 years. Two members of the Federal Reserve's Board of Governors, Michelle Bowman and Christopher Waller, broke with Chairman Jerome Powell and the majority of the committee, voting instead for a quarter-point rate cut. This double dissent is not just rare. It's the first time since 1993 that two governors have voted against the chair's decision in the same meeting. That alone makes this a historic policy moment. And it tells us there is a growing debate inside the Fed about the right course for interest rates. So what's driving the split? Those in favor of cutting rates now are looking at the labor market and seeing early signs of a slowdown. We've had downward revisions to job growth numbers, and the unemployment rate has moved up to 4.2%. For them, these are early warning signals that the economy might be softening enough to justify preemptive action. On the other hand, those favoring patience are focused on inflation. They want more consistent evidence that price pressures are firmly on a path back to the Fed's 2% target. From their perspective, moving too quickly could undo progress and risk re-accelerating inflation. When we look at inflation, we follow the Fed's own preferred measure, the Core Personal Consumption Expenditures Index, or Core PCE. This measure strips out food and energy prices, which tend to be volatile, and gives us a clearer read on the underlying trend. As of June, Core PCE was running at 2.8% year over year. That's well down from its peak in 2022, but still a bit above the Fed's goal. Economist Brian Westbury, First Trust, has been very consistent on a key point here. In his view, the money supply, measured by M2, is the biggest driver of the overall level of inflation, far more important than tariffs or other policy changes that affect individual goods. Tariffs may move prices around within the basket, but M2 determines the height of the waterline. After a historic contraction in 2022 and 2023, M2 has turned upward again, growing about 4% over the past year and remaining roughly $6 trillion higher than its pre-pandemic level. That's one reason inflation has been sticky in the high 2s to low 3s, rather than gliding straight to 2%. History offers some context as well. In the mid-1990s, when the federal funds rate hovered near 4%, core inflation averaged about 3.0%. In 2001, that figure was closer to 2.7%, and in late 2005, it was roughly 2.2%. Taken together, that works out to an average of about 2.6%. While history doesn't dictate the future, it suggests that rates around 4% often coexist with inflation in that low to mid 2% range. For investors, this backdrop means that even if the Fed does deliver one or two rate cuts over the coming year, cash and short-term bonds will likely remain attractive compared with what we saw in the decade after the financial crisis. A gradual easing in inflation without a sharp downturn in growth would favor intermediate-term, high-quality bonds as a stabilizing force in portfolios. In the equity markets, companies with strong balance sheets and pricing power should be well-positioned to navigate an environment of modest inflation and slowing but still positive economic growth. And while real assets and private credit can still play a role as diversifiers, we would be mindful of position sizes if the economy continues to lose momentum. In sum, the Fed's decision to hold rates steady was not the surprise. The surprise was the rare, historic double dissent, a sign that the conversation inside the central bank is shifting from whether to cut rates to when. Inflation is moving in the right direction, but money supply trends remind us the path will not be a straight line. History suggests we may settle into an environment where both rates and inflation are a bit higher than the norms of the last decade, but still well within a range that long-term financial plans can manage. If you have any questions or want to discuss how this relates specifically to your portfolio, please feel free to reach out. And if you haven't already, make sure to subscribe to our social channels and YouTube for more educational videos and helpful tips. Have a great weekend. We'll see you soon.
The Financial Flash is created by the experts at Styles Financial Services, creating customized portfolios that fit your unique lifestyle and goals.